Hi, I'm Jerry Fischkes, and I'd like to talk a little bit about FHA loans. Before I begin, I have to make clear that this video blog is for the purpose of conveying to you as a realtor some of the FHA basics. You might also like to share this video with some of your clients. And because there's really quite a bit to cover, you can look at this presentation as a first installment in a series of video blogs covering FHA basics. In this segment, we will be providing more or less an overview of the subject. So let's begin. Advantages. Well, the advantages to doing an FHA loan are the following. First, you need only 3.5% down on owner-occupied properties, including 2 to 4 units. Second, the buyer's entire cash investment can be gifted. Other advantages are there are no reserves required on 1 to 2 unit properties, and credit and underwriting guidelines are quite flexible. Also, the seller can contribute up to 6% of the closing cost. Fixed and adjustable loans are available. As a side note, most people opt for 30-year fixed-rate loans today, and I recommend them. By the way, the new loan limits as of March of this year are $729,750, and you don't have to be a first-time home buyer. So let's talk about underwriting. In other words, what does it take to get an FHA loan approved? You might say that common sense underwriting applies. You know that's kind of refreshing, especially in these times. Flexible ratios can exceed guidelines with compensating factors. For example, if your debt-to-income ratios exceed 44%, your loan might be approved if there are sufficient cash reserves or your credit and/or job history are strong. I can give you examples, but for the most part, each loan is reviewed on a case-by-case basis. Rather than providing you with various examples, why not call me to discuss your particular situation? As far as credit goes, even though a FICO score is not required, we will need some kind of proof that a buyer's credit history is acceptable. Non-traditional credit sources, such as utility bills, cable bills, rent checks, etc., can be used for this purpose. As far as the down payment goes, the applicant's funds for down payment and all closing costs can come from the following: a gift, an unsecured loan from an immediate relative, cash on hand, savings or a retirement account, gift equity from a relative when purchasing property from the same relative. This means, obviously, that non-arm's length transactions are allowed. For your information, statistically, 3 out of every 4 FHA loans are made to first-time home buyers, which is to say that 1 in 4 of these loans is to someone who either owns a home or has owned a home in the past. Which brings up an issue that I really should address because it's very important. Based on today's underwriting guidelines, if you own an existing home with less than 30% equity, you will be dinged for the entire mortgage, taxes, and insurance on your home when determining your debt-to-income ratios. In other words, if you are planning to rent your home, the projected rental income will not be included when calculating these ratios. And while we spoke about underwriting guidelines being flexible, this added monthly expense can possibly prevent you from qualifying for a new FHA loan. Well, that's it for now. On my next video blog, we will talk about how mortgage insurance premiums work, and we'll look at some specific examples and scenarios. Until then, you can call or email me anytime. I'll try to get back to you right away. Also, if you have any questions or issues you would like me to address in a future video, let me know. Thanks.